Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, there's Google's new AI overviews, which are crushing web publishers' revenue. Some are losing up to 40% of their income and creating a terrifying feedback loop for the entire internet. Then we'll look at why Meta's Llama 4AI flopped so badly that Mark Zuckerberg launched a $14.3 billion deal to completely overhaul his strategy. After that, we'll dive into the escalating resource war over rare earths and a $400 million Department of Defense deal aimed at breaking China's monopoly. We also have the story of how Cadence design systems funneled chip tools to China's military and how its former CEO then went on to run Intel. And finally, we'll cover Figma's stunning $18.8 billion IPO just months after regulators blocked its massive sale to Adobe. A new Google feature is causing some websites to see their revenue plummet by as much as 40%. It's called AI Overviews, and it's the AI-generated answer that now appears at the top of your search results. And according to a major study, it's completely changing our behavior. A Pew Research Center analysis found users are now almost 2 times less likely to click on a link when they see one of these AI summaries. In fact, 26% of the time, people just close their browser. This is a massive deal. For decades, the internet has operated on a simple contract. Creators make content, Google helps people find it, and creators earn money from the traffic, usually through ads. More clicks mean more ad views, which means more revenue. But AI overviews break that contract. People use Google search 5 trillion times a year, and for a huge portion of the internet that relies on ad revenue, this shift is catastrophic. According to one search strategy expert, Lily Ray, the new feature is having a devastating impact and removing the incentive for people to create high-quality content in the first place. Some experts are even warning this could destroy the web as we know it. This is where the situation takes a more complex turn, creating a terrifying feedback loop. AI models like Google's are trained on the vast library of human-made content on the web. But if those AI models stop sending traffic to websites, the sites can't make money and eventually shut down. The result? The AI runs out of new, high-quality human content to learn from. Researchers call this model collapse, a future where AI only learns from other AI, becoming a bland, repetitive, and inaccurate echo chamber. It's essentially starving the very ecosystem that feeds it. Google says this is all nonsense. A spokesperson called the study's methodology flawed and stated the company has not observed significant drops in aggregate web traffic. But this defense isn't just a PR statement, it's at the heart of a growing legal battle. In both the US and Europe, antitrust complaints are being filed that accuse Google of using its search monopoly to unfairly favor its own AI product over the independent websites it links to. The European Union's Digital Markets Act actually has rules specifically designed to stop this kind of self-preferencing by tech giants. So Google isn't just fighting a study, it's fighting accusations that it's breaking the law. But that's not the whole picture. The real turning point is a stunning twist. Google's own AI, Gemini, actually disagrees with its own company. If you ask it, Gemini says AI overviews do hurt websites, a fact that contradicts dozens of independent reports from web analytics firms showing traffic cuts of 30 to 70%. So who's telling the truth? Ray puts it bluntly. Google is trying to spin information and hide the truth because people will freak out. Google claims it's just giving people what they want, a more convenient experience, but critics say Google is just benefiting from the hard work of others. This convenience comes at a hidden cost. You know, when we get a single, neat AI answer, we stop doing the work of comparing different sources. We are, in effect, outsourcing our critical thinking. Recent studies are already finding a strong negative link between heavy AI use and our ability to analyze information for ourselves. We are training ourselves to accept a single answer instead of weighing multiple perspectives, which is a critical skill for navigating a complex world. This all leads to one chilling question. If websites start to go dark, it won't be because we clicked the wrong link. It will be because we stopped clicking at all. Speaking of the immense power of AI, one company's attempt to harness it just backfired so badly, it's forcing a complete overhaul of its entire AI strategy. That company is Meta. In a rush to compete with OpenAI, Meta released its new AI model, Llama 4. The reaction from its own developer community was so bad that CEO Mark Zuckerberg reportedly lost confidence in his generative AI team and its leadership. Now, Meta's open source models are a massive deal in the tech world. Research shows Llama models have been downloaded over 1.2 billion times. A huge global community of smaller businesses and independent developers relies on them because they are powerful and, most importantly, free. So the thing is, this whole ecosystem is built on trust, and that trust was just shaken. Zuckerberg's response? A spending spree to revamp the company's AI unit. The blitzkrieg kicked off with a stunning $14.3 billion investment into the data firm Scale AI. That deal brought Scale AI's CEO, Alexander Wang, directly inside Meta to help lead a brand new secretive unit, Meta Superintelligence Labs. They also hired former GitHub CEO Nat Friedman and poached top researchers from competitors like Apple, Google, and even OpenAI itself. This isn't just hiring, it's an aggressive talent grab, with reports of Meta offering compensation packages up to $10 million a year. What really brought this to a head was a development from a Chinese startup called DeepSeek. Its new model caught Meta completely off guard, leading to a frantic last-minute change in Llama 4's design. DeepSeek, a startup founded just last year, released an open-source model that achieved performance on par with the world's best, like GPT-4, for a tiny fraction of the cost, reportedly just over $5 million. This completely changed the game, proving you don't need a massive budget to create world-class AI. The result for Meta was a model that developers found difficult to use and that failed to deliver a significant leap over competing models. The technical reason for the failure is fascinating. Meta tried to copy DeepSeek's architecture, a mixture of experts, or MOE model. A traditional model uses its entire brain for every question, powerful but slow and expensive. An OAE model, however, is like a team of specialists. It routes a question only to the relevant experts, making it faster and more efficient. The problem is, this complex system is much harder for developers to customize, which is exactly why Meta's community pushed back. Now, everything is on the table. The new high-profile hires are questioning Meta's entire open-source AI strategy, even considering skipping the release of their most powerful behemoth version in favor of a proprietary model kept behind closed doors. This presents a fascinating duality for Meta. A study it commissioned found 2/3 of organizations believe open-source AI is more cost-effective. A move to a closed model would betray the very community that made Llama a global phenomenon. While Meta says its position is unchanged, Zuckerberg has promised to invest hundreds of billions of dollars in AI infrastructure. Now, you might be thinking this sounds a lot like the metaverse spending spree that worried investors, but there's a key difference. Unlike the metaverse, Meta can point to immediate, tangible results from its AI investments, such as increased user time on Facebook and Instagram thanks to AI-driven recommendation feeds. That's a metric Wall Street understands. The goal is clear: regain momentum and potentially create technology that steamrolls the competition, no matter the cost or the change in strategy. That story about a Chinese startup really highlights the new competitive landscape. And that competition isn't just in software, it's heating up in a critical resource war where one country now controls 90% of the processing for the most important bargaining chip in the US-China trade war. We're not talking about oil or gold. We're talking about rare earths, a group of 17 elements that power everything from your phone to electric vehicles, wind turbines, and critical defense equipment. Interestingly enough, they aren't actually rare in the sense of being scarce. The name comes from the fact that they are incredibly difficult and costly to separate from each other. For decades, the world has depended on China, which mines 70% and processes nearly all of these materials. Mining the ore is the easy part. The real bottleneck, where China has a stranglehold, is in the processing. Separating these chemically similar elements is a highly complex, capital-intensive, and toxic process. China has spent decades mastering this, building a huge lead in both expertise and infrastructure. According to one expert, China has maintained this monopoly with what they call sub-rational prices, making it nearly impossible for anyone else to compete. It's a classic example of a state-controlled industry outmaneuvering free market capitalism. A private company has to make a profit, but a state-backed industry can sell at a loss for years to achieve a long-term strategic goal, in this case, global dominance. Now, that dominance is being used as a weapon. China has placed export controls on rare earths, disrupting entire industries, especially the auto sector, This is particularly true for elements like dysprosium and terbium, which are essential for the high-performance magnets used in EVs and wind turbines. One analyst says this isn't a new strategy, stating China has spent years mimicking and copying US export controls to hit back. But the United States is finally getting serious about fighting back. The Department of Defense just announced a massive $400 million investment in the American rare earth producer MP Materials. And that's not all. Goldman Sachs and JP Morgan are backing the same company with a $1 billion loan. This isn't just a commercial loan, it's a deeply strategic move. The DoD's involvement is so deep that they've effectively become a major shareholder, even guaranteeing a minimum price for the materials nearly double the current market rate to ensure the company can thrive. The story takes another turn with a company that historically mined uranium energy fuels. It has realized it can use a similar process to refine rare earths in Utah and is already on track to produce enough material for up to 6 million EVs. But here's the catch. Reshoring this industry comes with serious environmental questions. Many rare earth ores contain radioactive elements like thorium and uranium, creating waste and raising complex safety questions. The US is clearly mobilizing, but despite these massive investments, experts warn the US is still far from breaking its dependence on China. The resource war is being fought on multiple fronts, not just mining at home, but also through innovation, like developing rare earth-free magnets and through international alliances, or friendshoring with countries like Australia and Canada. This fight is far from over. We were just talking about the US government's massive push to counter China, but believe it or not, a major American tech company was just caught doing the exact opposite. Get this. A major American tech company, Cadence Design Systems, just pleaded guilty to secretly funneling sensitive chip design tools to a Chinese military university, the same one the US government believes is involved in simulating nuclear explosions. The company has agreed to pay a staggering penalty of over $140 million. This wasn't a one-time mistake. Court papers show this went on for years, with at least 56 illegal exports between 2015 and 2020, even after the university was on a restricted trade list. They allegedly did it using front companies and aliases. This isn't just about breaking trade rules, it's about a sophisticated cat and mouse game of sanctions evasion. Research shows that entities trying to get around these rules often create incredibly complex corporate structures using layers of shell companies to obscure ownership. It's a systemic failure of due diligence that these front companies exploit. The technology in question, electronic design, automation, or EDA software, is the absolute key to everything. These tools are the master blueprints for designing every advanced microchip in the world. The US dominates this market, which creates a strategic choke point. By controlling access to EDA software, you control who can build the next generation of supercomputers, AI chips, or even missile guidance system. Giving an adversary access is like handing over the keys to the kingdom of advanced technology. However, if you zoom out, you'll see another layer to this story that's even more shocking. After Cadence, whose customers include NVIDIA and Qualcomm, admitted guilt and agreed to the massive fine, its stock price actually went up. What's truly remarkable is what this tells you about Wall Street's perspective. The stock jumped 6.5%, suggesting investors see a $140 million fine as just an acceptable cost of doing business compared to the profits from years of sales. It raises a big question. If a penalty this large isn't a real deterrent, what is? The investigation reveals this all happened under the watch of a specific CEO, Lip-Bu Tan, who ran Cadence from 2008 through 2021. He later went on to become the CEO of another tech titan, Intel. The implications here are stunning. Intel is a cornerstone of America's strategy to bring chip manufacturing back to the US and a major recipient of CHIPS Act funding. The fact that its former CEO was at the helm of Cadence during this period of illegal exports raises enormous questions about national security and corporate governance. Was it rogue employees? Or was it a systemic failure of oversight at the highest levels? The US government has emphasized holding individuals accountable, and this situation puts that very principle under a massive spotlight. From a story of corporate accountability to one of incredible resilience, let's talk about Figma. The most unexpected news in the business world today has to be this. A $20 billion tech deal gets blocked by regulators, but the company being acquired, Figma, just turned around and announced it's going public with a jaw-dropping $18.8 billion valuation. That's just shy of the original 20 billion Adobe was forced to walk away from. So how are they commanding a price tag that massive? The numbers tell the story. In the most recent quarter, Figma's revenue skyrocketed 46% year over year. But the real bombshell is its profit, which jumped threefold to nearly $45 million. These aren't just flashy top-line numbers. The underlying health of the company is incredibly strong. For instance, Figma has a net dollar retention rate of 132%. What that means is for every dollar a customer spent last year, they're spending $1.32 this year. They're not just keeping customers, they're getting them to spend more and more over time. Wall Street is leaning in hard. One analyst at IPO research firm IPOC says investors are responding to companies with, quote, credible AI exposure, and that Figma has done a good job aligning itself with that theme. So let's dig into that AI exposure claim. In its official filing to go public, Figma mentions AI over 150 times and is spending 40% of its new R&D budget on it. But there's a crucial detail here. Despite this massive investment, the company has not yet reported any direct revenue from its AI features. This suggests a big part of its valuation is being driven by investor excitement for the promise of AI, not its current financial impact. Another firm, D.A. Davidson, is even more direct, calling Figma the, quote, right company to lead the charge into the public markets. This is bigger than just one company. It's a major signal. Blackstone's president recently stated, the deal-making pause is behind us. And Figma's success is being seen as a major validation for the UK and EU regulators who blocked the Adobe deal. Their argument was that the merger would stifle competition. Now, with Figma thriving independently, it proves their point and could embolden regulators to scrutinize other big tech mergers even more closely. Figma trading under the symbol FIG could be the one to kick the door wide open for a new wave of high-growth tech listings. After being blocked from a massive buyout, the company is now on the verge of a massive public debut on its own terms. And here's one more layer to this whole saga. During that failed merger attempt, Adobe got an intimate look at Figma's financials and strategy. Now, Figma has to compete in the open market against a giant that knows its playbook. That's why it's racing to innovate with AI, not just to please investors, but to stay one step ahead of a very powerful, very well-informed rival.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.